Hello, welcome back. Um, we are moving on to the next topic, the equity valuation, and of course, this is nothing new. We've already covered this topic in the Finance 100, but again, we are not just reviewing, but we are looking at it from a slightly different um, perspective, and also we are beefing up uh, the contents that was covered in the Finance 100, right? So this is more enriched, more enriched, um, more beefed up lecture on uh, stock valuation. So the first thing is the several valuation. When we say value, right? Value of the company, value of the equity, right? There are several, comparables or several of values, and of course, the most obvious one is the book value. And the book value is, and I've been telling you over and over, there are three different types. There are three different values, at least when we are, in Finance 100. That's what I told you. Because when you wanna see, if you want to check what's the price of Tesla today, or what's the price of Apple today, you would simply, go to information source like Yahoo Finance, or Bloomberg, or wherever you can look up the quoted price, and the price quoted, that's market price, right? In other words, that's the result of the demand and supply, and that's the resulting from transaction. So of course, during the day, while the market is open, there are constantly this price is in flux, right? Goes up and down, goes up and down, right? Oscillating or vacillating, up and down. And so, it changes, even every second, right? Because every time whenever there is a transaction, is by the end of, but transaction is happening all sporadically. It's not like all buy and sell demands are all met all at the same time. At once the market opens, at 9:30 there can be one transaction. I mean, every second there can be a transaction. But sometimes there's a long pause, right? There's no transaction for a while, and then suddenly, so many transactions all happening at it. So we all know the price. There are even the market price during the day of the trading. There are at least four different prices. First, opening, then high, 4 price points, right? High, that's the highest price during the day's trading, and the lowest point during the day's trading, and close price is of course, when the market closes, right? And I've been telling you, it's always the close price that is, that we need, because we don't, no matter how high during the day it reached, or no matter where it started, or no matter how low it reached during the day. That's not the price. Those are not the prices that represent the day. The price that represents the day's trading is always the conclusion of the day. So it's always the close price that we need. Of course, some people ask, don't we need to use no average? Average price doesn't have the it doesn't give you the full picture of the dynamics of the price action from day to day, because from one day to the next, average won't vary that much unless there's a crazy shock to the market. Now, and you may have noticed that the most stocks are suddenly on decline since a couple of days ago, since last Thursday. And August 31st, the Apple and Tesla had stock splits. So after the stock split, actually, the price came down, actually. The reason for stock split is usually because when the price gets too high, it becomes more onerous to trade. Meaning that if I have only, let's say if I have $1,000, right? Tesla was almost $2,000, I believe, before pre-split, and then they had 5-to-1 split. I cannot buy even one share of Tesla. Of course, you can buy fraction, you can buy a fraction, these days, but for example, I want to, if I have only, $2,000, then I can buy only one share of Tesla. And then if I bought, of course, Tesla was, giving you very good return, but once again, that was irrational. And if I bought instead, $400 stocks, or even $100 stocks, I could buy 20 of them, right? And then if I needed liquidity, I could sell. If I needed $1,000, if I needed to cash out, in other words, I needed cash, and I could cash out $1,000 from my stock holdings and still leave $1,000 in the stock, right? Because if I bought $100 stocks, assuming they were giving you pretty much the same return as Tesla, or at least the average market return, I could buy 20 of them, and I could leave, just cash out 10, right, and just leave 10 there, right? So I could easily liquidate. In other words, my cash flow, there's liquidity. I don't have to worry about liquidity. But if I have one Tesla stock, all $2,000 tied up in one Tesla stock, I need $1,000. I need $1,000 in cash. There's no way I can cash out half of it, right? This is the reason. Of course, these days you can, as I said, you can buy, fraction, if you can buy fraction, Robinhood, But, conventionally, that was the case, right? So they had So liquidity and the marketability is the main reason behind the stock split is the liquidity and marketability, right? And think about it. There's no reason after the split, the price. There's no reason for the price should come down if market perceived that Tesla was overvalued, and everybody knew Tesla was overvalued. But knowing that it is overvalued, grossly overvalued, right? Grossly. I would say fair value of Tesla pre-split was only about around $80. But then what should be about $80, the rational price or the intrinsic value or the fair value? What should have been $80 was trading for like $2,000. So there was no question, no doubt that Tesla was overvalued, right? But still, there was that momentum, and still, market in the irrationality, market irrationality was still, because everybody wants to jump on the bandwagon. While Tesla is doing so well, everybody wanted to jump on the bandwagon, and that fueled the demand. That fueled the crazy demand, right? So this is the problem. This is the problem. Stock market is always crazy, irrational. They say irrational, but in other words, it's just crazy, right? In the short run. And the market price is the result of that irrationality. So the market price is not fair value. You understand? Market price is not the fair value or the rational price or intrinsic value, right? So, and I've been telling you in Finance 100, I was telling you that there's market price and book value and user value. So book value, what's the book value? It's the price based on the book. And the book value is usually the refers to the if you remember, financial statements, right? Book value refers to the total equity value, by the book, by the balance sheet. But then, excuse me. Well, and then how do we compare that book value with the market price? Because market price, always the price is a per unit, per share concept, right? Per unit concept. So per share concept. Well, why not? If the total equity is, let's say, $5 billion, if total equity is $5 billion, and if there are 5 million shares outstanding, 50 million shares outstanding, 50 million, total equity value, 5 billion, 50 million shares outstanding, then what's the book value per share? Simply divided by, the name is book value per share, divided by number of shares, then you get $100 per share, right? So that's the book value per share, book value. But in the slide, what you see here is actually the equity, right? Equity side, right? The book value is always the purchase cost, right, of the asset, cost of acquisition, minus accumulated depreciation. So this is what accumulated depreciation. Well, this is how you value the fixed assets, right? Of course, equity. If you have equity, right, $5 billion, and if you're a manufacturer like Tesla or Apple, right, this $5 billion equity is not just held in, cash, right? There's no reason you invest in a company that just holds cash doing nothing, right? Um, these companies use this cash to acquire production equipment, expand the plant, and acquire fixed assets. So production equipment, in other words, and inventory and things like that. So some of this 5 billion may be still held in cash, but a lot of it is put into acquisition of fixed assets, right? So this is the way, this is how book value is calculated. That's basically financial accounting. Of course, if the plant and equipment, production equipment, all cost $5 billion, and all $5 billion raised by selling stocks, raised through equity, was all put into plant and equipment. So the book value of the equity is exactly the book value of the plant and equipment, right? Makes sense. And as time goes on, it gets there's depreciation. So if you book value of the plant and equipment divided by number of shares outstanding would represent the book value per share. Of course, you might think over time, then the book value per share would lose. If you don't make any more, if there is no equity generated from production activities, then of course it will go down. But you will, through production activity will result in the products, and products will result in sale, and from sale sale will result in the profit. Profit is sale will result in, of course, the revenue, right? Sales, it will result in profit. That profit is equity, right? Not the equity paid in from paid in capital, right? Capital paid in, but equity generated from production activity or operating activity. So book value doesn't necessarily go down. Yeah. And also, anyway, but the limitation of book value is not the actual value. In other words, it's not the market value. Market value is a value as a going concern, although market value is irrational in the short run. Market in the long run, it will be an equilibrium, and if it is an equilibrium, it will be equal to the intrinsic value, right? That's the basically economics assumption behind it. Now, intangibles. Another thing is book value cannot reflect intangibles, brand equity, expertise, etc. Now, liquidation value is the net amount after selling assets and paying off debt. Yeah, think about it. What does this mean? This is exactly the balance sheet, the capital structure, right? If total assets is equal to, right? Total assets is equal to, or are equal to, equity plus debt. So then, if you have to pay off all your debt today, what do you have to do? So if you went bankrupt, usually that will be the case when the company goes bankrupt. Uh, you will have to liquidate. You'll have to sell off everything, right? All the assets, right? Pay off debt, and whatever is remaining, whatever is left, is the equity value, right? But then this may be, you will sell it at the market price, or as suppose assuming that it is sold at market price, all assets are sold at market price. Then but it won't, right? It's not going to be that's not going to be the case. When you all your assets would, if you are bankrupt, probably sell below market price. That's why it is the true floor price for the stock, right? Whatever is left is the equity, and then you divide it by number of shares. That's true floor price. If the market price is less than liquidation value, think about it. This is a good deal, isn't it, right? I mean, how can liquidation value would be most likely, under, valued, right? Uh, but if the market price is even lower than that, it's even below the floor, right? So this is a very good deal for takeover. They become takeover. Corporate raiders buy at market prices, sell for liquidation value. If that is the case, there are uh, if you I don't know if you ever saw the movie Wall Street One, the original Wall Street. There were a couple of there was Wall Street Two that came out in early 2009, but the original Wall Street One was in 80. It came out in 84, 85. And probably, hardly anyone amongst you, anyone in this class, could possibly be old enough to remember Wall Street, were actually around when that Wall Street One came out. But if you have time, watch that movie. There are I recommend the movies like Wall Street One, Wall Street Two, Glenn Gary, Glenn Big Short. I mean the movies about Wall Street. Not because that's educational. I mean, it's really the true face of Wall Street. Wolves of Wall Street. Very. It's more reflecting the negative side of the Wall Street. Yeah, and I agree. There isn't, uh, uh, it's not, it may look, glamorous, but obviously, very reckless life and unethical, immoral, just. But anyway, in Wall Street One, liquidation. Gordon Gekko in that movie was Michael Douglas. Uh, was the corporate raider, right? And I mean, it's takeover. They were taking over this airlines that was going down. Charlie Sheen was the son of the union leader of that airlines, local airlines that was going down. And, A Pretty Woman was also about corporate radar, actually. Now, the next one is the replacement cost. Replacement cost is the cost to replace firms' assets at current value, right? Now, the current value, think about it. If you were to replace, let's say, you have a car and the insurance company, you have insurance, right? If your car is totaled in an accident, of course, hopefully not, the insurance will pay for replacing the car, but they won't pay you. They will pay you. They won't pay you the new car value, right? In other words, the original equity value. If you, of course, you cannot call the car your equity unless you don't have any financing, right? If you pay, everything. But just if you pay cash to buy the car, then that's your equity. Of course, they won't pay you the new car price. They won't pay you. They will pay you. If your car is 3 years old, they will pay you. They will pay you what the 3-year-old model, right? 3-year-old, car of your model, right, is going in the market. So you might think, oh, replacement cost is then always less than the original book value. No, not necessarily. Sometimes it could be higher if the uh, just take your imagination away from the car and suppose yeah, you bought stocks of some company that is a year ago that was worth share price was $100, and a year later it is worth $200, right? Why is it worth $200? Because the total equity value has gone up. The firm's valuation has gone up. If you were to replace the firm's assets, right, and the assets have gone up more in value. And something got better, right? Production equipment, how can production equipment can go up in value? Isn't there a depreciation? No, they had, innovative, innovative, attachment, innovative, improvement to the production equipment, then the value goes up, right? So, okay, if I turn it into and then there's a small video. I don't know if you can watch the video, watch this video, but let me see if I can share. What's that? I will have to wait. What's happening? Oh, I'll have to stop sharing and then share application. Okay, you may be able to see my entire screen. Yeah, ready? So you see my entire screen. So let's see.
Would you believe a few simple changes in your diet?
I don't know if this audio is also audible to you, but all right. So I'm not sure if you could hear the audio on that small video, right? But let me go back to oops, not this one. Okay. So that's the replacement. That's the replacement cost, right? It could be higher or lower, but and an economist named Tobin, he was, like 1950s economist, and I even forgot his, first name, but he was a Nobel laureate. He won a Nobel Prize in economics, and because of his, this ratio or quotient, Tobin's Q. What's Tobin's Q? If the firm's market value is the ratio between firm's market value and replacement cost, and theoretically, uh, if the firm's market value is, less than replacement cost, right? Uh, that's, the implication is if the replacement market value is less than the replacement cost, then you have to dump the stock. That firm is not really worth, holding. Or, from the firm's perspective, they need to reinvest to improve, uh, reinvest in the firm to bring up uh, their market value above the replacement cost. But theoretically, the Q, Tobin's Q, cannot remain greater than 1 for long because of competition. And empirically, but empirically, there are some instances of Q remaining greater than 1 for long. So obviously, if there is a company like that, then that's a buy target, right? It took it took longer than I thought, but I will have to cut the video here, and I will see you guys in the video, next video. All right. Thank you for watching. Stop recording.